You would think that with the prospect of higher inflation and more interest rate increases from the Federal Reserve, that would be a good thing for the U.S. currency.
Well, theoretically, inflation is actually bad for the currency. To maintain what's known as a stable real rate, the nominal exchange rate actually has to depreciate when inflation is going up. But more generally, I think the issue here is that for a given level of rates, and foreigners are willing to pile in and buy dollars to finance America's current account deficit and external financing needs. But as perceptions of those financing needs change, and I think perceptions have changed quite dramatically over the last 6 weeks or so since the tax cut was put through, essentially investors are going to require a higher rate to buy dollars, and clearly we haven't achieved that sort of equilibrium rate yet.
That's what I love about economics. There's always a model to fit the price action, even if you have to switch it up occasionally to justify.
On one hand and on the other. They've never met a one-handed economist. So.
At what point then, if this theory is correct and it's about relative interest rate differentials and the compensation that you need in order to perhaps buy assets or buy currency, at what point then does that kick back in for the US dollar?
Well, yeah, that's quite literally the million-dollar question. And to some extent, it depends on how much people expect the current account deficit to deteriorate, the trade deficit to deteriorate, how much they expect the budget deficit to deteriorate. Now, you could make an argument based on historical relationships going back to the 80s and 90s that you would need rates to go up like 3%. To really turn up by 3% to re-energize a bull market. It's probably going to be would probably be less than that, but clearly on the basis of history, you're not compensated nearly enough to own dollars given the external deficits.